If you're a business owner paying more than 20% in taxes in 2026, you are voluntarily tipping the IRS. Because most people don't realize that the government recently passed massive tax law changes that completely rewrote the rules for this year. While the average person is losing money handing their hard-earned cash to the government, wealthy entrepreneurs are using these exact changes to legally pay $0 in taxes. I'm Henok Kebede. I'm a licensed certified public accountant and founder and CEO of HK Financial Advisory. We are a premier tax strategy firm specifically built for business owners, high-income earners, and entrepreneurs. See, for years, we've helped our clients save over 5 figures in taxes by using advanced IRS code optimization and not just basic tax filing. So today, I'm going to be breaking down 5 advanced tax strategies that you can implement right now in 2026. And by the end of this video, you will have a clear blueprint to keep massive amounts of capital inside of your business instead of sending it to Washington. This is specifically for business owners and high-income earners who want to build real wealth. You need to stay until the very end because the 5th strategy involves a state tax workaround that most traditional accountants don't even know exists yet. Let's get right into the strategy number 1, which is arguably the most powerful wealth building tool in the tax code right now. Let's talk about how to write off massive purchases in a single year. See, under the old rules, bonus depreciation was scheduled to drop to just 20% in 2026. But here's where people mess this up. They don't realize that the recently passed One Big Beautiful Act permanently restored 100% bonus depreciation for qualifying assets placed in service after January of 2025. This means you can immediately deduct the full cost of qualifying business assets in year 1 alone, rather than spreading the deduction over 5, 10, or 39 years. So let me give you a real-world example of how we help clients do this correctly. Imagine you purchase a $2 million commercial building for your business. Normally, you would depreciate that over nearly 40 years, getting a tiny deduction each year. But by executing an engineering process called a cost segregation study, we identify all the non-structural components of that building. We are talking about the flooring, the specialized lighting, the HVAC systems, and the parking lot. Often we can reclassify 30% of that purchase price as 5, 7, or 15-year property. That is $600,000. Because of the new 2026 rules, you can take that entire $600,000 deduction in year 1. If you are in the 30% tax bracket, that single move just saved you over $220,000 in cash. And who qualifies for this? Any business owner purchasing commercial real estate, heavy equipment, or vehicles weighed over 6,000 pounds. The biggest mistake to avoid here is buying an asset and waiting until your tax return is due to tell your CPA. You must execute the purchase and place the asset into active business service by December 31st of the current year to qualify. Strategy number 2 is one of the strategies we use to help business owners keep their hard-earned money within their own family tree. See, the concept is called income shifting, and it involves paying your children for legitimate work they do for your business. For 2026 tax year, the standard deduction for a single individual has increased to $16,100. This means that any person can earn up to $16,100 and pay absolutely $0 in federal income tax. Here is the real-world example of how this plays out. Let's say you are a high-income entrepreneur in the top tax bracket, and you have 2 teenage children. So instead of giving them an allowance from your after-tax personal bank account, you hire them to work in your business. They can do social media management for you, data entry, office cleaning, or even modeling for your marketing material. You can pay each child $16,100 for the year. That is $32,200 completely removed from your high tax bracket, giving your business a massive deduction. And because that income falls under your children's standard deduction, they pay 0 federal income tax on it. You just transferred over $30,000 tax-free. And who qualifies, you may ask? Any business owner with children who are old enough to perform legitimate, age-appropriate tasks. Usually, the IRS accepts this for children aged 7 and older. Here's where people mess this up. The mistake to avoid is paying them directly from your personal checking account or failing to document their work. You must pay them as contractors from your business account, and you must keep timesheets detailing the work they performed. The deadline for this is strict. The work must be completed and compensation must be paid out before December 31st of the tax year. The Section 280A corporate retreat is also known as the Augusta Rule. This is a heavily underutilized section of the tax code that allows you to rent your personal home to your business for up to 14 days a year, completely tax-free. See, most people don't realize that the IRS literally wrote this exemption into the law. It means your business gets a legitimate tax deduction for the rental expense, and you, as the homeowner, do not have to report that rental income on your personal tax return. So let me break this down in a real-world example. Let's say you own a highly profitable S corporation, and you need to hold monthly board meetings or strategic planning sessions or team building events. So instead of renting a conference room at a high-end hotel, you rent your primary residence to your business. And if comparable luxury rentals in your area go for $1,000 a day, your business can pay you $1,000 for each day you use it. If you do this for the maximum 14 days, your business gets a $14,000 tax deduction. And that $14,000 flows into your personal bank completely tax-free. So who qualifies for this? Business owners operating as a disregarded LLC, S corporations, C corporations, or even partnerships. This works well. Sole proprietors cannot easily use this because you cannot legally rent to yourself as the same entity. The biggest mistake to avoid here is failing to provide the market rate. You cannot just charge your business $10,000 a day for a modest suburban home. You must pull rental comparables from sites like Airbnb or PeerSpace to justify the daily rate. And you must document the business purpose with meeting minutes. This strategy must be executed and the money transferred before the end of the tax year on December 31st. If you're operating as a single member LLC and making good money, you are likely bleeding cash through self-employment taxes. When you are a standard LLC, the IRS taxes every single dollar of your net profit with a 15.3% self-employment tax. That is on top of your standard federal and state income taxes. This is where the S corporation election changes everything. By electing to have your LLC taxed as an S corporation, you divide your income into two categories, a reasonable W-2 salary and owner's distribution. Here's a real-world example. Let's say your consulting business nets $200,000 a year. As an LLC, you are paying 15.3% self-employment tax on the entire $200,000. But as an S corporation, we might determine that a reasonable salary for your specific role is $80,000. You only pay the self-employment taxes on that $80,000 salary. The remaining $120,000 flows to you as an owner distribution, completely bypassing the 15.3% tax. That single strategy just saved you over $18,000 in a single year. So who qualifies for this? Entrepreneurs and business owners who are consistently netting over $60,000 to $80,000 a year in profit. But here is the mistake to avoid, and the IRS watches this closely. You cannot pay yourself a $0 salary or an artificially low salary just to avoid taxes. Your salary must be considered reasonable based on what you would pay someone else to do your job. If you get greedy, the IRS will audit you and reclassify your distribution as wages, hitting you with the massive penalties. The deadline to elect S-Corp status is typically March 15 for the current tax year, but late elections are possible if handled by a professional. Pass-through entity tax, or PTET workaround, is our fifth strategy. This is an incredibly powerful tool for high-income earners living in states with high income taxes. See, most people know that the current law that just recently passed caps your state and local tax deduction on your personal return of up to $40,000. So if you live in a high tax state and pay $50,000 in state taxes, you simply lose out on an additional $10,000 of deduction. But here's the constraint inside. You can shift that tax burden to the business. The PTET workaround allows your business to pay your state income taxes on your behalf. Because the business is paying it, it becomes an uncapped, fully deductible business expense on your federal return. So let me give you an example on how this plays out. If you owe $60,000 in state taxes on your business income, paying it personally means you only get to deduct $40,000. By making the PTET election your S corporation or partnership pays the entire $60,000 directly to the state. Your business deducts the full $60,000, lowering your federal taxable income massively. And at a high tax bracket that creates over thousands of dollars in pure tax savings. So who qualifies? Business owners structured as pass-through entities, meaning S-Corps or partnerships, who live in one of the roughly 36 states that have enacted the PTET legislation. The biggest mistake to avoid is missing the election deadline. These deadlines completely vary widely by state. Some require the election to be made by March 15th, while the others require estimate payments throughout the year. You absolutely must have a proactive tax strategist managing this timeline for you. Before we wrap up, I want to give you one short high-impact bonus strategy. It is Section 179 Heavy Vehicle Stack. If you need a vehicle for your business in 2026, do not buy a lightweight sedan. If you purchase an SUV or a truck with a gross vehicle weight rating over 6,000 pounds and use it more than 50% for business, you can combine Section 179 and the restored 100% bonus depreciation. See, this allows you to potentially write off the entire purchase price of a $70,000 luxury SUV in the exact same year you buy it. Just make sure it is placed in service before December 31st. If you're watching this, you now realize that real wealth is built through tax strategy, not just tax filing. But here's the hard truth. Tax planning must happen before December 31st. If you wait until April to talk to your accountant, it is already too late because you are only reporting history at that point. At HK Financial Advisory, we help clients implement these exact strategies to legally minimize their taxes and keep their capital working for them. If you're a business owner netting over $70,000 a year and you are tired of overpaying the IRS, I want you to click the link in the description or the pinned comment below. Book a one-on-one tax strategy session with my team today. We will review your current situation and show you exactly where you are leaving money on the table. Do not wait until the end of the year when our calendar is completely booked up. Click the link below, and I'll see you on the other side.